The Great Depression was a financial and economic crisis with devastating consequences, not only for the United States, but also for all the countries with close ties to it. The United States economy appeared solid in the 20s, with an unemployment rate of 3.7% and an annual economic growth above the long-term historical average. In the same period, technological innovations shifted the demand for labor towards skilled workers, such as machine repairers, for example. Low-skilled workers were paid less than skilled workers. Unfortunately, increases in manufacturing productivity did not translate into more jobs or wage increases, but increased corporate profits by 62%, with dividends doubling. To further favor the condition of the richer classes, tax cuts on the highest incomes were implemented in 1921, 24, and 26. If in 1922 the 1% with the highest income owned 49% of the total savings in the United States, in 1929 the same percentage stood at 80%. New products such as automobiles, refrigerators, and radios drove economic growth in the early 20th century. However, the strong inequalities that worsened during the 1920s led to limited demand for these products, with spending supported thanks to the expansion of credit. The use of debt made it possible in those years to make the problem of inequality less visible. Investment funds move from the productive sector to the financial sector, stimulating speculation and the creation of new credit instruments. This led to a real estate bubble that exploded in 1926, before the stock market crash. The social classes below the elite struggled considerably in trying to maintain their social status. The richer class transferred debt to them in the form of financial instruments. Until the late 20s, growth was driven by profits rather than increases in wages. The influence that the elite had in shaping public opinion in their favor was significant. In those years, there was a strong move towards a laissez-faire and pro-business type of ideology. Those who promoted greater government intervention in the economy were judged to be subversive. There was a strong pressure to limit trade unions to a minimum, and university economics professors with progressive ideas were, in many cases, threatened and expelled. Under such pressures, academics began to expose free market ideologies typical of the right. Market deregulation was therefore supported even in the face of the greater inequality caused. The ideological influences of the elite were difficult to counteract due to their pervasiveness, possible by the enormous amount of resources at their disposal. The significant increase in unemployment, deflation, and the fall in production happened during the crisis blocked the US economy for several years. Furthermore, the Fed was unable to provide useful responses to limit the impact of the recession. The Great Depression hit the US economy extremely hard. As you can see from the table, the unemployment rate increased from 3.2% in 1929 to 24.9% in 1933. Output growth was negative for 4 consecutive years, with a first recovery in 1933. Looking at the nominal interest rate column, you can see a slow decline from 1929 to 1933. One-year government bond yields fell from 5.3% in 1929 to 2.6% in 1933. Inflation was negative from 1930 to 1933 due to the fall in production and employment. In 1934, the economy managed to return to positive inflation rates, which led to a recovery in production. The 20s were a period of extremely remarkable growth for the US stock market. From a value of 63 in August 1921, the Dow Jones Index reached 381 in September 1929. However, this rapid growth soon stopped. In the so-called Black Monday of the 28th of October in 1929, the Dow Jones fell by 13 percentage points. The pre-collapse values were only reached again in November 1954. In fact, in the late 30s, a series of banking crises turned what might have been a typical recession into the Great Depression. At the time, Caldwell & Company was the largest financial holding company in the southern United States. It offered its customers a wide range of banking, brokerage, and insurance services. The company's general headquarters was in Nashville, Tennessee. The bank faced serious financial difficulties following the stock market crash in 1929 due to excessive equity exposure. It managed to stay afloat until the following year thanks to state deposits. However, on the 7th of November 1930, one of the main branches of Caldwell & Company, the Bank of Tennessee in Nashville, was forced to close. On the 12th and 17th of November, branches in Knoxville, Tennessee and Louisville, Kentucky also went out of business. The failure of these institutions generated panic among depositors who began to withdraw their funds from other banks as well. Within a few weeks, hundreds of banks suspended operations. In the following months, only a third of these institutions reopened. Most of them faced liquidation. On the 11th of December 1930, New York's fourth largest bank, the Bank of the United States, ceased operations. The bank was negotiating a merger with another institution with the help of the Fed. As soon as the negotiations ended unsuccessfully, savers rushed to withdraw their deposits and the institution was put in a position to close. The banking crisis that began with the collapse of Caldwell & Company faded in early 1931. But in June of that year, a new crisis began, this time in the city of Chicago. The crisis of these regional banks hurt the national economy in many ways. First, they made it much more difficult for businesses to access credit. Even if they had managed to negotiate loans, interest rates would have made them prohibitive. On the 21st of September 1931, Great Britain abandoned the gold standard, and later they promised to guarantee a certain amount of gold in exchange for its banknotes. Concern developed that the United States might do the same thing. Foreign holders of dollars then began to convert the currency into gold. This resulted in a significant reduction in the country's gold supply. At the same time, depositors concerned about the stability of the banking system withdrew cash from banks. The Central Bank of New York intervened by raising the interest rate applied to loans and bank acceptances. The goal was to increase the return on US assets to attract more foreign capital. In January 1932, the United States Congress created the Reconstruction Finance Corporation. The RFC was a state financial institution whose purpose was to lend money to banks. It was recognized as an instrument capable of boosting the confidence of the entire nation. It was authorized to make loans to any financial institution, accepting as collateral the assets considered suitable. Typically, loans were aimed at those institutions characterized by assets with sufficient long-term value to repay creditors, but which could have short-term liquidity shortfalls. Furthermore, in April 1932, the Fed began a program of open market operations which resulted in total purchases of approximately $1 billion within a few months. In the first half of 1932, the trail of bank failures seemed to be over in the face of an improvement in economic conditions. However, towards the end of 1932, a new wave of bank failures began. Among the factors that contributed to creating an unfavorable climate was uncertainty regarding President Roosevelt's economic policies. He was elected in 1932 but did not take office until March of the following year. In February 1933, the Fed raised interest rates again, as it did at the end of 1931. The goal was to limit the decline in gold reserves. However, once again, the Fed did not decisively carry out open market operations. For an entire week in March 1933, all banking transactions were suspended. The objective was to stop bank failures and to recreate a climate of confidence in the entire financial system. George Harrison, head of the Federal Reserve Bank of New York, and Eugene Meyer, the director of the Federal Reserve Board, were fundamental figures in the definition of the bank holiday. Harrison, on the first day of March 1933, reported that the United States gold reserves were below the legal limit. Fed-linked banks were required to maintain gold reserves equal to at least 40% of the money issued. once again, dollar holders, both domestic and foreign, were losing faith in the currency, converting it into gold at an alarming rate. According to Harrison, the best way to curb the outflow of gold was to declare a real pause in the national banking system. He would not have taken responsibility for administering the New York Reserve Bank in the absence of a sufficient number of the reserves. On the 6th of March 1933, President Roosevelt issued an order to suspend all banking transactions, effective immediately. Furthermore, a way had to be found to prevent the reopened banks from failing. The proposal was to reopen the banks in various phases. There was a classification of banking institutions into the following classes, A, B, and C. Class A banks had a very low or no risk of failing. Class B banks were weakened or insolvent, so the reopening had to be preceded by a period of internal reorganization. Class C banks were insolvent institutions that were not allowed to reopen. On the 9th of March, the Congress passed the Emergency Banking Act. The goal of this act was to restore Americans' confidence in the banks that would be reopened. 4 days later, the member banks of the Fed obtained authorization to reopen, and on March 15, the banks controlling 90% of the entire state's banking resources restored the ability to carry out operations. Furthermore, deposits significantly exceeded withdrawals, demonstrating the greater level of solidity achieved. Primary attention was paid on the possibility that for the reopened banks, bank runs could occur again. Among the causes that led to the Great Depression, the literature recognizes the role of growing inequality and income stagnation of the working class during the 20s. The issue of inequality was extensively covered by Keynes. An optimal distribution of income has a negative impact on aggregate demand and therefore leads to a decline in production, given that companies decide how much to produce based on future demand expectations. Furthermore, the marginal propensity to consume is greater for low-income individuals compared to the segment of the population with more availability. The response of the Federal Reserve to the 1929 crisis was recognized as insufficient and full of errors. If the response to the stock market shock in 1929 was rapid through the lowering of the interest rate and the sharp increase in loans to banks, the bank failures of 1930-33 were almost ignored. Too little was done to limit the collapse in prices and production. Following the crash of 1929, the Fed of New York implemented open market and lending operations aimed at injecting liquidity into the banking system. These actions were effective in containing the crisis and preventing the spread of panic among depositors. At the beginning of 1930, the New York Fed put pressure on further expansionary measures. However, the Federal Reserve Board rejected calls for a further rate cut and more open market purchases. Thus, in the first half of 1930, lending by the central banking system decreased by about a third. The money supply, after increasing following the stock market crash, decreased in 1930 along with the credit granted. It is believed that the decrease in the money supply was the main cause of the subsequent decline in production. As shown before, between 1930 and 1933 there were several waves of banking crises. In the last months of 1930, in September 1931, following the United Kingdom's decision to abandon gold standard, and in the period between the end of 1932 and the beginning of 1933. In each of these occasions, the credit granted by the Federal Reserve underwent a reversal process, that is, loans were increased in proximity to crisis only to be then reduced again in the immediately following periods. At this point, we need to ask ourselves the reason why the Fed immediately after each shock from 1929 to 1933 contracted the credit granted. One reason can be found in the Fed's failure to correctly interpret information on money market interest rates and loans related to the discount window, which is a unit of the Fed aimed at offering loans to those banks that, for example, are unable to obtain credit on the interbank market. At the time, the low levels of interest rates and the limited use of loans from the discount window were interpreted as conditions that would have made the injection of greater liquidity useless. The officials of the main central banks did not see any need for further stimulus to the economy, given the already low cost of credit. Between October and December 1930, numerous US banks failed. Most of them were small banks which did not belong to the Federal Reserve System and therefore unable to borrow through the discount window. Some scholars have pointed out that the Fed made a grave mistake in not bailing out the Bank of the United States, a medium-sized New York bank and component of the Fed system. The possible bailout attempt of the bank went up in smoke through a merger. No one wanted to guarantee $20 million in assets for the bank. The Fed let the bank fail, concentrating its efforts on containing the subsequent consequences. Fed officials were hesitant to make open market purchases because they didn't see banks willing to use the credit to pass it on to their customers. Other central banks officials were concerned about the impact of the purchase operations on the amount of gold reserves, even though the Fed was shown to have enough. The economic literature offers various reflections on the similarities and differences between the Great Depression and the 2008 crisis. The comparison between the methods of central bank intervention deserves particular attention. The Fed's response to the 2008 crisis were markedly different compared to that of the last century. Previous experience has certainly provided relevant indications regarding the mistakes not to be repeated. During the Great Depression, as seen, the Fed allowed the money stock to fall. Consequently, strong deflation occurred. By contrast, in the most recent crisis, the money stock increased steadily, with prices remaining stable through the entire period. The Fed did not make the mistake of confusing low levels of lending in the discount window with the idea that banks did not need further liquidity. On the contrary, in 2008 it encouraged the use of loans from banking institutions. An anonymous fund transfer system was also introduced. In this way, no stigma was associated with depositors, thus avoiding bank runs. The Fed has shown itself willing to offer loans to avoid the bankruptcy of those institutions capable of generating systematic risk. This did not happen in the 30s. No attention was paid to this type of risk, and as seen, it was decided not to save the Bank of the United States from the collapse. With respect to the last point expressed, it should be underlined that also Lehman Brothers failed due to the Fed decision not to guarantee the last loan to avoid bankruptcy. What differentiated the Lehman case from that of the Bank of the United States was the subsequent response. In 2008, the bankruptcy was followed by an $85 billion loan to save the American International Group and the development of the Asset-Backed Commercial Paper Money Market Fund Liquidity Facility, or AMLF, a program aimed at providing credit to financial institutions. In contrast, during the Great Depression, there were limited responses following bank failures. As in the 2008 crisis, also in the Great Depression, the real estate market favored the propagation of financial shocks. Speculation not only affected the stock market, but also the real estate market. Through debt, a significant portion of the population was able to acquire ownership of a home. There were also social consequences linked to the purchase of real estate. For many owners, it is not only about building generational wealth, but also about signaling their social status. A crisis originating from excessive indebtedness concentrated on the lowest segment of the population can quickly transfer to the financial system. Both the Great Depression and the 2008 crisis arose from very high levels of debt, particularly mortgage debt.